So any of you go to Scott's signing books today, right? Scott Galloway? Huh? What is it? Algebra of, I don't think that's the title of the book. Scott would never call a book financial security. It's something more exciting than that. So it's Scott, Scott and I go back a long time, and we get along because we have very similar views on how to express ourselves. So we used to do a session for the freshman undergraduates. It's like shock therapy, right? Because they'd come in expecting this academic discussion, and Scott would go off on Facebook, and Scott loves Facebook, right? So it was actually, it's a lot of fun. So if you get a chance, do get the book. It's called Algebra of Life or something like that, about life lessons and financial security. It's a fun book to read. So let's talk about real options. And as we said, we've kind of set up the discussion. So what I'd like to do is use today's start of the class just to kind of bring home the essence of real options. So let's suppose you're a small startup. You've come up with this new technology. Cell phones are all, make it new AI technology. The AI technology is going to do something nobody's done before, but it's incredibly expensive to produce. Right now, it's not viable. So here's my first question, right? Let's say the cost of implementing the technology is $2 billion. You do the present value of the cash flows. It's $1.5 billion. Should you implement the technology now? What's the answer? No, that's a slam dunk. But let me ask you the follow-up question. Let's suppose somebody approached you, a big tech company comes in and says, I'll buy the technology from you. This sounds like they're doing you a favor, right? You have a non-viable technology, they're offering to buy it from you. Would you be, if you're the tech company, would you be willing to pay for that technology even though it's not viable today? If I have 15 or 16 years left on the patent on this technology. What do you think, Emma?
There would be risks involved.
Oh, they're always, in fact, you want risks to be involved. If this is guaranteed, how much would you pay for a technology that's non-viable today? Zero, because it's guaranteed. In fact, you want uncertainty, right? So rather than running away from uncertainty, you're running towards it. It's precisely because the future is uncertain that you might pay for the technology. Because what could change? The cost of the technology can change. The value of the technology could change. It's an option.
I mean, that 1.5 of expected cash flows
could become 70. It could go to zero. And you have to be real, right? What happens to most out of the money options? They end up going in the trash can. But when they pay off big time. And now, how many of you own call options on Tesla before close of trading yesterday? Right? Stock was down to 144 and rumors were coming out. This is going to be terrible. But you decided to swim against the tide, bought a call option with a strike price of 160. Today, you're looking good. Because as you know, it came out after. In fact, when you look at the earnings, it looked bad, but it shows you how expectations drive pricing. The stock was up $17 after close of trading yesterday after the earnings report came out. This wouldn't be possible in a Black-Scholes world, right? You know why? Because for a stock to move $17, what has to happen is go 1 cent, then 2 cents. It just jumped $17. A clear example of what jump processes do. It's a non-viable technology, but you're buying it because things can change. And the reason you're buying it is because you have exclusive rights. That's a key part of the story. Buying non-viable technology where you don't have an exclusive right is extremely dangerous because anybody can then jump into it. It's viable. It's because you have it and you have it alone. So it's an option. I want you to keep that in mind because let's say you're getting ready to buy the non-viable technology. I want you to think about what will happen if I change a couple of parameters. Let's suppose initially you thought I had 10 years left on my patent. And I said, no, you're wrong. I have 15 years left on the patent. Holding all else constant, what does that do to the value of this technology?
The patent is longer.
Yep.
It makes it more valuable.
It's life of the option extent. What would happen if Guillermo talked about uncertainty. In this case, I mean, I think you meant it as that's a negative. But in this case, the more uncertain I feel about the AI business, the more I'm going to pay. No wonder there's so much excitement around AI. We know it's a big business. Nobody has any idea right now how big the business is going to be or what form it's going to take. You're going to see a lot of optionality, people buying out of the money options. 90% of them will end up in the trash can, but of the 10% that pay off, the payoff is big time. Yes.
You're saying uncertainties. I guess, are you talking about that in a negative sense?
In this case, it's a positive because
Yeah, I guess that would depend on the industry, right?
in every industry, non-viable technologies in every industry become more valuable as uncertainty increases. Every industry.
Even if your uncertainty is that it might go there.
Well, uncertainty, if you set expectations right.
Yeah.
Basically, uncertainty is always relative to expectations. Uncertainty can never be more downside than upside, right? Because basically your expectations take care of setting the center on uncertainty. You built that into your expected cash flows. Uncertainty is around the expectations. So you can never have just downside uncertainty because then your expectations that went into your initial $1.5 billion cash flows was clearly set too high. So let's say you buy this non-viable technology. Folks, can I ask you a favor? Can you please move out of this section because the noise is coming into the classroom? So let's say you buy this non-viable technology. They're not going to listen, so it's fine. And it does become viable at some point in time. Let's say 2 years into it. You made the right bet. The technology has now become viable. Will you develop it right away? You see what I'm asking, right? Net present value is now turned positive. The rule in capital budgeting is take it. But is there a reason you might wait? Do we exercise options the minute they go in the money? Not necessarily, right? There could be a time premium. If by waiting, you actually get more information about the market, you can come up with a better product. There might be a benefit to waiting. Every lesson in option pricing plays out in the real world when we think about non-viable technologies and real options. So with that background, let's go back to where we were in the lecture note packet. And we were talking about option pricing models. So Mladen, tell me what I need for option pricing models to work.
Well, you need a strike price.
No, first I need replication. Replication means I need to be able to trade the underlying asset and trade the option. And I need arbitrage, which is people trading at right prices together. And we also talked about Black-Scholes model designed to value what kind of options? European options, right? Which you can exercise only at expiration. Let's take a patent as an option. We're going to talk about that today. You have 17 years on the patent. That's the life of the option. Would you ever want to wait till the very last day of the 17th year to develop your patent? You wouldn't, right? Because as you wait, you are facing a cost. What's the cost? Every year you wait, you're giving up a year of protection. It's like a dividend yield, the cost of delay. In a real option, early exercise is a feature, not a bug. That's what you should expect to see. And there are people who've used that argument for why they don't use Black-Scholes models to value real options. They say Black-Scholes models are designed for European options. The real options that we face are all American options. I can't use Black-Scholes. So if you don't want to use Black-Scholes, what do you have to do? You have to use a binomial model, which allows for early exercise. But then as a consequence, you also have to draw that binomial tree with all the branches. And I don't even want to go there. I've never seen anybody actually draw a binomial tree for a real option. They'll talk about it. So you know what? I'm going to use a Black-Scholes model, even though I know it's for European options. But remember what I said, when you value European option, you're getting a floor on your value. So if I tell you based on the Black-Scholes model, that the real option here is worth 80 million, the true value is going to be some number greater than 80 million. And I'm okay with it being a conservative estimate. Now, incidentally, if you want to go the binomial path and you start to draw out a binomial tree, you're actually one step away from a decision tree. You know what the difference between the binomial tree I showed you last session and a decision tree is? in a decision tree, in addition to giving me the numbers, the prices of each, you also tell me the probabilities of each branch. Once you get there, you don't need any option pricing. If you draw a full-fledged decision tree, you can do everything we do with real options without bringing that machinery of options of S and K and R and T and C. I think we underutilize decision trees and valuation. And then we talked a little bit about decision trees in the context of valuing companies under different scenarios, right? I brought in decision trees for failure risk, value the company going concern. But decision trees are particularly useful when you have risk that is sequential and discrete. Let me repeat that again. Decision trees are particularly useful when you have risk that is sequential. You know what I mean by that? You got to get through one stage to get to the second stage, and they're discrete. What does it mean? It's success or failure. What kind of business faces a lot of sequential risk, which is discrete? Sorry? Any kind of pharmaceutical company and a healthcare company which develops a new drug. So in my book, I actually took an example of a drug to treat diabetes. And the question the company is facing is, should we start the R&D on this drug? Remember, it's too late to wait until after you've done the R&D, because then it becomes a sunk cost. So I drew a decision tree. And this is made up because clearly I don't know enough about diabetes, but this is one of those areas where there's enough data that you can actually attach the probabilities. So there's stage one, you're going to test the drug. If the test succeeds, then you're going to follow up and do a, so with each stage, you got to get through the previous stage to get to the next stage. And at each stage, I attach the probabilities of the events happening and the expected outcomes. At the end of the process, I actually end up with a drug in those scenarios where I work through all the way to that end stage. And the end drug can be just for type 1 or type 1 and type. So basically, it can range the spectrum from a really big blockbuster drug that treats all kinds of diabetes to drugs that treat just type 1 or type 2. So the end outcome is basically a DCF valuation. But the decision tree gives me a front end of bringing in the uncertainties I face when I look at a biotech company or a pharma company. Yes, Ritu. They're discrete at each stage, right? At each stage, it's success or failure. What I mean by discrete is, if you have a test market, we have a range of outcomes from very successful to not successful, and you're going to develop an 80%. So it's essentially you have these intermediate solutions. It gets more difficult. It's not that it's impossible. Now I have to draw more branches. So big success, medium success. So here it's either go on or don't go on. So that's what I mean by the discrete. It's easier to use decision trees when you have that consequence. David, you look a little puzzled. Because by the time you get to the end and it's still a drug, at that stage, looking forward, the drug will create value, but it will not cover the costs you've already incurred to get there. But remember, it's a sunk cost by then. It's pointless to not develop the drug at that point. So the negative values indicate that in hindsight, if you'd known, you'd never have started the process. But that's the way uncertainty unfolds. So it's called folding back the decision tree. If you fold that decision tree all the way back to today, you can get a value today. And if that value is positive, you know the signal you're getting, right? Go out and do the R&D because the expected value is positive.
Then you can have associated stock price as well.
That's it. So basically, investors build it in. That's what you look at young biotech companies. What are they building in? They're building in an expected value of the success, which means if they get negative news on a stage, the whole thing can come apart very quickly because the probabilities have shifted very quickly. Yes.
Would you weight the money value by time?
It's all time value. So basically, I'm still following all the rules of taking the time value of money. So if it takes 8 years to get to that end stage, that's got to be factored in the present. It's not a technique I pull out of my toolkit that often. But if you have sequential risks and risks that you worry about piling on top of each other. The other scenario this is useful for is investments that have regulatory approval that's needed, infrastructure investments where this sequential risk then plays out.
Use it for early stage startups.
You could do for early stage startups, but the problem is it's often not discrete, right? It's not abandon or walk away. It's kind of this mush in the middle where you continue as a smaller, less successful business. So the more it becomes difficult to separate success from failure, the more difficult it becomes to use decision trees. There, I would be more inclined to use Monte Carlo simulations because that allow for distributions. So here are the key tests we're going to run in every real option. First, we're going to ask, is there an option embedded in this decision/action? What are we looking for? We're looking for payoff diagrams. This will give us away, right? Limited losses, unlimited profits. Second stop, is there exclusivity? Why? Because only if there's exclusivity is there value. So if there's exclusivity, there's an option value. If there's no exclusivity, there's no value. And then you look at the intermediate effect. And third, can I use an option pricing model to actually put a number on the option? There I'm going to look at, is the underlying asset traded? Is the option traded? Can I do replication arbitrage? Because that's going to allow me to use an option pricing. For every 100 options that people often say, is there an option here? They're very quick to throw the word in. And the more you have MBAs in the audience, more they'll throw the word in because they've heard it in class. There's optionality here. There's optionality there. There's optionality behind the bush. And for every 100 options that people throw at me, maybe 2 or 3 make it through to that last stage where I actually tried to use an option pricing model for that. So let's start with options in capital budgeting. Some of you in my corporate finance class will make a big deal of capital budgeting. Take the cash flows, we take the discount rate, we come up with the net present value. And in traditional NPV, there are 3 options that are not in that NPV. The first is the option to delay. We're going to start with that option because it's going to give us insights into why non-viable, why patents and non-viable technologies have value. Then I'm going to talk about the option to expand, where an initial investment gives you the right to a second investment. And the third is the option to abandon, where if something doesn't go off, you get the right to walk away. There are very few real options that are put options. The option to abandon happens to be a put option. So only real option that I know of that's a put option, the rest are call options. What do these options do? You come up with the net present value. Let's say it's negative. I know the capital budgeting rule, don't take the project. But these options can often mean that you would override the NPV and take the project anyway. And that's why they're so powerful and so dangerous, because they're making us override. One of the central themes in corporate finance is don't take negative net present value investment. So let's start with the option today. When you compute the NPV for a project, you're computing what the value would be if you took the project today. That's basically what it said. So the negative NPV means don't take the project today. But the fact that a project has negative NPV today doesn't mean it's going to have negative net NPV for the rest of its life. So as I said, with every one of these real options, I'm going to start by drawing the payoff diagram and talking about the underlying asset. In the case of the option to delay, the underlying asset is the project you're looking at. The present value of the cash flows becomes the S in the model. The strike price becomes the initial investment you need to invest to get the project. I want to make sure everybody, so the underlying asset is the project. The present value of the cash flows becomes the S in the model. The initial investment becomes what you need to invest today. Right now, what did I say about the project? It's a negative net present value project. It's an out of the money option. So why am I buying it? Because something good can happen. That negative net present value can become positive. The present value of the cash flows, in the example of $1.5 billion, could become 2.5 or 3 billion, in which case I invest in the project and I make the difference. Is it possible that the project will never pay off? Of course. In which case, what did I lose? Whatever I spent to get the rights to this project. But the key here is you and only you can take the project. So let's use this first to talk about patents as option, and second to talk about undeveloped reserves at a commodity company. Let's start with the product patent. The essence of a patent is you get the exclusive rights to develop this patent into a commercial product. Keyword is right. You're not required to. Now, I remember about 20 years ago, I was looking at the list of companies with the most patents. You know what's on top of the list? This was true even 10 years ago. IBM was on top of the list. 137,000 patents. Sony, 83,000 patents. You're saying, well, aren't they worth a lot? Most of the patents are completely useless. They're out of the money so much that they will never get developed. But a patent gives you the exclusive right to develop a patent into a commercial product. Let's assume that the cost of developing a patent into a product is I. I know it's an abstraction, but let's say it's I. Let's say the present value of the cash flows from developing it today is V. So what am I saying about this option today? About this patent? Right now, V is less than I. It's an out of the money option. But if you have the exclusive rights, which you do in a patent, sometime during the life of the patent, you're hoping and you're praying that we will become greater than I. You will develop the patent. That's a happy ending story. Or the alternative is we always stays less than I. At the end of 17 years, you throw the patent into the trash can and said, that wasn't a good idea. So in terms of payoff diagrams, the cost of converting the patent into a product becomes the equivalent of the strike price. The present value of the cash flows from developing the patent today becomes the equivalent of the stock price. The remaining life on the patent becomes the life of the option. And you do an option pricing to basically value the patent. We'll talk about the limitations of trying to bring in option pricing models here, but that is the underlying option. So I'm going to talk about getting the inputs, because clearly we can talk about this in abstract. And this is what I was to struggle with. You'd see this talked about in the abstract, but when you ask, have you ever tried this? I don't know, but I can show you in the abstract. But who cares about the abstract? So we need to apply option pricing models. What do we need? We need SK, TR, and sigma. So with every one of the real options, I'm going to give you my best effort to try to give you those numbers. So let's say you have a patent and you want to come up with an option pricing value for the patent. You need a value for the underlying asset, right? The underlying asset is the product that will come out of the patent. So I'm going to ask you to try to estimate the expected cash flows you will get if you develop the patent into a product today. You know what you're going to tell me, what your pushback is going to be? Guillermo, I'm going to ask you to compute the present value of the cash flows from a product on a patent you haven't developed yet. You're going to tell me the same thing. There's a lot of uncertainty, right? Say, welcome it. This is a good thing. Make your best estimate. Come up with an expected cash flow and come up with a value. You're going to come up with a number. I agree with you. It's going to be an estimate and it's noisy, but that becomes the S in the model. The variance in that value, you can try going looking up on Bloomberg, the variance in some but you're not going to find it, right? There are two ways you can estimate a variance. I'll give you the lazy way. You're a biotechnology company, you're looking at projects, you might say, I'm going to look at publicly traded biotechnology companies and the stock price variance. It's a crappy way to think about variance. But if you're in a hurry, you can do that. The alternative is, remember Monte Carlo simulations that we did? In a Monte Carlo simulation, what do you get? You get an expected value for the cash flows. You also get a standard deviation of value. You can give me a variance if you're willing to. This is one of the great things about simulations is they feed in easily into real option models. The variance becomes an input. What's your strike price? It's whatever you need to spend to convert your product patent into a commercial product. And it'll vary across different businesses, but it can be huge in some businesses, small in others. So I've got S, I've got K, I've got sigma. Then I ask you for a life of the option. And this is easy on a patent. The life of the option is just the remaining life of the patent. That becomes life of the option. The risk-free rate becomes whatever the risk-free rate is over that remaining life. The question is, can you actually do this for a patent? And if you have a company, I'll tell you, take this off the plate. You cannot do this from the outside because the information you need will often be information that only the company has access to. So I'm going to use an example that is very dated, and I'll tell you why I've stayed with the dated example rather than trying to update it. It's a company called Biogen. It's still around. It's a biotechnology company. And they'd come up with a drug to treat MS called Avonex. They just developed the drug. They patented it. That's 17 years left on the patent. And the reason I was able to do this option pricing is I got my hands on an internal capital budgeting analysis they'd done in Avonex. Have you ever seen pharmaceutical companies project cash flows in drugs? It's terrifying. Because here's what they did. They took the entire population of the US, it was going to be a drug just for the US. They took the percentage of those people of the population that has MS. And they have a pretty good idea. Let's say it's 11%. That might be too high, but whatever it is. Then they take the percentage of those people who go to a doctor, and it's not 100%. And then they take the percent of people who go to a doctor who get the right diagnosis, and that's not 100% either. And then they take the percent of the people who've been diagnosed with MS who actually take the drug, and that's definitely not 100% because insurance comes in, whether it'll be paid for. So it's actually a very morbid exercise. They do the MS, they come up with this potential market. And then they estimate how much they can charge for the drug. What do you think goes in there? How much can we push Medicare? How much can we push it? Because remember, this is, so they make their estimates, so they've done the estimates, and the present value of the cash flows they got from developing the drug right away was $3.422 billion. It's good, right? But at the time that I did this analysis, Biogen had never actually developed a drug on their own. They actually had developed drugs and sold them to the other pharma companies. They had no sales force, no infrastructure. Now, if you've ever gone to a doctor's office in the US, you'll often see pharma salespeople come through. They'll carry gifts with them and all kinds of neat stuff, samples. It's a very expensive process. And if Biogen decides to develop the drug, it's estimated it'll cost about $2.875 billion to set up the infrastructure. If I paused right there and I told you the present value of the cash flows is $3,422 million, and the cost of developing the infrastructure, the initial investment is $2.875 billion, what's that difference? It's $547 million, 3.422 minus, what would that difference be called in a corporate finance class? That's the net present value of the project. This is a project with an NPV. And in the corporate finance class, that's it, we're done. It's a positive net present value, but I'm going to carry it forward. They haven't developed the drug yet. They have 17 years left on the drug. The risk-free rate was about 6.7% for a 17-year time horizon. I brought in the fact that there's a lot of uncertainty in this business about the future by taking the lazy way. I didn't run a Monte Carlo simulation because I didn't have crystal ball then. I'm doing too much work. Today, I might have done a simulation. The standard deviation so I took the stock prices of biotech companies. Implicitly, I'm assuming that variance reflects the variance in the underlying cash flows, and I put in that variance. Is this drug viable right now? Yeah, it's a positive net present value investment. You develop it. But is there a benefit to waiting after you can learn more about side effects and you might be able to finesse the drug. You might be able to make the market bigger, charge a higher price. There's always this thing, pharma companies face once a drug is developed and it's viable, say, if I wait, I can make this drug more, I wouldn't say powerful because that looks at the health effects, but more economically powerful because I can make more money on it. Okay? But if you do that, if you wait, there is a cost of delay. What's the cost of delay? You decide, let's say you decide, even though it's viable, that you're going to wait a year, collect more information, you're going to lose 1 out of the 17 years of protection you have, right? From competition. So that becomes the cost of delay. It's like a dividend. Remember what dividends do to call options? They make them less valuable. Each year that I wait, I'm giving it up. So that's why I said the dividend version of the Black-Scholes model is going to be the one that I'm going to draw on because most real options, there's a cost to wait. I've got every input, SKRT, I plug them in. I get a D1 and an D2 and an N of D1 and an N of D2. But the bottom line, I plug in those values, I get a value for the call of 907 million. Let's back up. What is the net present value of this drug? 547 million.
That's if you do it.
If I do it right now. But the optionality gives me, there's some good news and bad news here. The good news is there's option value, but the bad news, if you're an MS patient here, is what is that valuation tell me? If I develop it right now, I get 547 million. If I wait, it's worth 907 million. The bad news is I'm going to wait. And you're going to sit there with the disease saying, why isn't that drug coming out? I'll talk about what might push back against this, but I actually took this and I worked this value out. So I said, what happens there? Because remember, as I get closer and closer to the patent running out, the cost of delay rises over time. It goes from 117 to 116 to, there'll be a tipping point. And in this case, the tipping point doesn't happen till 9 years from now. You're sitting there with MS for 9 years waiting for the drug to come out and say, why isn't it coming out? I'll complete the story. Biogen developed Avenix within 2 years of doing this. What do you think made them speed up the process? Here, my cost to delay is 117, but if you're Biogen, what is your true cost of waiting? Remember, the patent gives you protection against anybody else developing exactly the same drug. Does it give you protection against other people working on drugs for MS? No, it doesn't. At the time that I did this, Merck and Pfizer and Upjohn were working on their own MS drugs, and it was estimated that Biogen had about a 5 to 6 year lead time on them. You see what that does to your cost of delay, right? Is a 1/17th, I use 1/5. The cost of delay rises so much that the value of the option drops below 547 million. If you're in a competitive pharmaceutical business and there are lots of people working on drugs in that same area, the optionality starts to disappear because the cost of delays. But if you're a monopoly pharmaceutical company, you can see the implications, right? If Glaxo owns the ulcer drug, and for a long time they did, and they develop a better ulcer drug, I guarantee you they're not bringing that better ulcer drug to the market as soon as you'd like them to, because they're going to cannibalize their own product and they're going to wait. It's not great news for patients when they're in. So the areas where the optionality is greatest is in these rare diseases, where you don't have 20 companies working, you have one company working on a drug for that disease. There's going to be all this game playing as to when that drug will actually hit the market, because there is this trade-off between developing it right away and collecting the positive net present value. So yeah, go ahead.
So we have the S&P. So if we exercise the option now, so the difference between the S&P, I think it's like intrinsic value of the company.
It's a net present value. Basically, that's what a net present value. It's an intrinsic value for a project. So when you exercise the optionality is gone. Yeah.
That's around like 500.
547. And the extra 360 million is because of what you can gain by waiting, the time premium on the option. So I think the problem is, I'm assuming I have 17 years of protection, but in truth, I have about 4 or 5 years before somebody else comes out with an MS drug. So if I take the same calculation and make that 1/5, the cost of delay becomes 20%. The value of the option actually drops to 480 million, less than. So that's going to push me to exercise early, because you say, look, waiting here is going to cost you a lot more than exercising now and collecting the equity.
So all that from the last row, is that the,
No, that's the total value. 907 minus the 547 would be the premium. The 360 million would be the premium. Yes.
Cash flows from other sources.
Doesn't, but in a sense, your VCs are going to cash out at the highest price. They're doing it for exit, right? So if you can show them that waiting for 2 years will get them a higher value, hey, they've waited already through your negative cash flows. And if they think they can increase their value by 10%, they will. Now, can you use this approach to actually, because that's the value of single patent. So can you use this to value an entire firm? In theory, yes. You can take a pharmaceutical company and value it in 3 slices. You can value the developed drugs already, because that's the existing cash flows. You can do it on a DCF. You can take the patents like Abonex, value them as options and add them on. And there's a third layer that is a complete nightmare. You have an existing R&D department, right? What's your R&D department working on? Coming up with new patents. Think of that as a third layer, and the question is, does it add value? Does it do nothing for value, or does it destroy value? So that slice is a bit of a nightmare. I'll show you how I tried to deal with this in the case of Biogen. But you could actually value companies using this approach, but if you do it, just make sure you're not double counting. I'll give you an example of where I've seen double counting. I saw somebody who probably read my book. He said, look, I took your approach and I valued the pharma company. Here's what I did. He said he did a discounted cash flow valuation of the pharma company. And then after he done it, he valued the 2 big patents that they had as options, and he added it to the DCF value. So I asked him the question. What's the question you need to ask when somebody does that?
Did what?
They did a discounted cash flow valuation of the pharma company, and then they took the 2 big patents that this pharma company had not developed yet, valued them as options, just like I did Abonex, and added it to the DCF value. That's exactly the question I asked. When you did the DCF, what did you use as a growth rate? He said, I used really high growth rate. And I said, why? Because they've got these 2 patents that are going. And I said, you can't have your cake and eat it too. If you want to do this, you got to strip the growth you're going to come from the patents and then value them separately. You already see why you don't want to use the approach value of Merck or Pfizer. You'd be pulling your hair out by the time you're done, because not only do you risk the double counting, but you'll have 300 patents to value. But if you have a small biotech or a pharma company with much of its value coming from one patent, now, I don't know how much of Novo Nordisk's value right now comes from Ozempic and Wegovy. Be an interesting exercise to strip just those two out, value them as options and say, hey, this is how much of Novo Nordisk's value comes from these. Because that'll answer the question, what am I buying when I'm buying Novo Nordisk? Am I buying a traditional going concern value, or am I buying two big options? Because your dynamics and value are going to be very different. So here's what I did to apply this for Biogen. They already had two commercial products. One was a drug to treat hepatitis B and a second drug called Intron. I don't even know what it treated. They developed them, they'd licensed them out. Now, the way licensing works in the drug business is I can structure a license either as a fixed fee license, where Merck or Pfizer will pay me $50 million a year. And it turned out that they'd structured both these drugs as fixed fee licenses. I'll give you the alternative. But if you have a fixed fee license, you make $50 million. It's a contractual commitment that the pharma company that bought the license is giving you. At $50 million every year for the next 12 years. How would I value it? I need to take the present value, $50 million. At what rate? What's the risk in these cash flows? That Merck or Upjohn or Pfizer, which has guaranteed the cash flows, could go bankrupt, right? What captures that? The cost of debt of those companies. Whenever you think about discounting, always go back to what is the risk in these cash flows. So I discounted those cash flows back at the pre-tax cost of debt of the guaranteeing companies, because that's what's going to drive my risk. The present value of those cash flows was $397 million. Don't be too quick to jump on the cost of capital bandwagon. We're so quick to compute cost of capital, used as a discount rate everywhere. This is not an operating cash flow. It's a contractual cash flow. The risk you're worried about is default risk. There's another way you could have structured these licenses where you get a % of revenues. If that had been the structure, what would I have used as my discount rate? If I told you they got 50 million last year, but their future cash flows are going to be 20% of the revenues on these, clearly an operating cash flow, the discount rate there would have been the cost to capital. There are some contracts that's structured as a percentage of net income. So whatever earnings you make on the drug, you get a % of. If that's the way it'd been structured, it would be an equity cash flow. I could have used. So if you ask me, what's the discount rate apply on these licensing? I'll have to know how the licensing agreement is structured to make that. That becomes the first slice, 397 million. So that's the value of the existing drugs. The value of Avonex as an option is 907 million. And then I turn my attention to the third slice, and it's a nightmare. There's continuing R&D. And I made an assumption, and these assumptions could be wrong and drive the third slice. I took their R&D expenses, and they were pretty clear. They were going to spend more and more on R&D for the next 10 years. So I was able to project out the R&D expense part. But remember, value doesn't come from spending more. It's what comes out of the R&D. I made the assumption that they would deliver about $1.25 in value for every dollar invested in R&D. Let me tell you how I came up with the $1.25. Now, if a company earns a return on capital equal to its cost of capital, when it invests $1, what does it get back? Roughly $1, right? Basically, that's what the return on capital is. I took the return on capital of biotechnology companies and the cost of capital of biotechnology companies. The return on capital was about 6% higher than the cost of capital. And I said, if I invest $1 in this company, how much would the dollar create value? That 6% difference translates into about $1.25. I'm implicitly assuming that Biogen is going to be able to generate those excess returns on continuing R&D. So what that effectively does is for every dollar that I invest, I get $1.25. It is risky, so I'm going to use a much higher discount rate on that, a 15% cost of capital. And here's what the value of continuing R&D becomes. There's my R&D expense that's projected. I start with that. That times $1.25 gives me the value created each year on an expected basis. That difference is my excess value, discounted back at 15%. I get 318 million. What if I told you R&D is neutral in this company? It earns roughly the cost of capital. This becomes very easy, right? The value is going to be equal to the cost, the excess value is zero, the value created. What if my company has R&D that's value destructive? That means you're earning less than the cost of capital. $1 in R&D will create 80 cents in value. You'll get a negative excess value. You can see all three play out. If you're valuing Merck right now, the present value of R&D is probably negative. I know it's a perverse outcome, it's going to happen. With Novo Nordisk, usually you look at the history of the company, right? And the real challenge you face with a company like Novo Nordisk that Lambert is valuing is you have a history of R&D, but let's face it, it was for a very different company, right? It was a diabetes company, it produced drugs with folk. They're now trying to do R&D like a big pharma company. I have absolutely no idea. And I'll be quite honest, my cynical side is saying you take a Danish company, what is it, Scandinavian company that keeps 9 to 4 hours every day and gives people 30 days off, the R&D might not be as productive as you think it is. And the scientists who might come to work for you have a selection bias. You might be spending money coming from Ozempic and Wegovy, but your R&D might actually be draining value, which in a perverse way is saying, no, maybe a Novo Nordisk would be worth less, staying a small company, treating this as a windfall and not trying to scale up R&D to be a Pfizer or a Merck, even though they have the money. No. So that is the value of continuing R&D, and you add the three numbers up, I get a value. You're saying, you know what that is analogous to? That's like taking the present value of free cash for the firm and discounting back at the cost of capital and coming up with the value today. What do we do to get from that to the value of equity? We add cash, we subtract our debt, we subtract our options, you do all of that stuff. It's just a different pathway to the same end game. The value per share that I got for Biogen was $45.70. About half that value comes from one drug. That Avonex would go through, which means any news about the drug is going to have a significant effect on your value per share because it's such a big slice of the value. So as I said, with every real option, I'm going to stop and ask the three big questions. Is there an option here? Yes, I clearly think there is. The underlying asset is the drug that comes from the patent or the product that comes out of the patent. The contingency is the present value of the cash flows exceed the cost I will develop that. So that's an easy one. Is there exclusivity? Where does it come from? It comes from the government's willingness to enforce patent laws. Let's face it. If I have a patent in China, I might value that patent a lot less than a patent in the US if I feel it's not going to be enforced as strongly. And if the government doesn't enforce it at all, forget about optionality, it's gone. So exclusivity comes from how well the patent is. But on the pricing test, I'm going to have real trouble. What do we say you need to apply option pricing? The underlying asset has to be traded. Zero chance of that happening. The option has to be traded. Patents might be bought and sold once in a while, but they're not traded. There's no market price. It's not like I create a replication. I can use an option pricing model as I have, but I have to remember that that value that I'm getting is a shaky number, right? Because I can't monetize it. Replication arbitrage is broken down. So the 907 million, if you came to me and offered 750, I'll probably take it. 675. That's where it plays out, is how much am I going to stand behind that number? And here my answer is not much, because the option pricing model is built on premises that don't apply. So any questions about valuing a patent as an option? Yes.
Previous slide.
Yeah.
As the value bunch. So the value of the existing products and the existing patents both relate to the same drug, right?
No. Existing products and drugs already developed that they've licensed out. So 380 million was Intron and the drug to treat hepatitis that they produced, they'd licensed out. The option is on Avonex, a drug they haven't licensed out. So you can't count the same thing twice. So these are actually three separate drugs, two already licensed out, one just patented, but they haven't licensed out yet.
No, I thought you were valuing the patent just for patent's sake.
No. I never value anything for its own sake, right? You have to make sure that you add valuing it because you haven't brought it in yet. Yes, just.
Like a month, or a DCF for a month post.
You could,
kind
and
of like
yeah.
doing the kind of similar thing.
You could basically, in fact, that's if Crystal Ball actually has a real options add-on. You can actually, they charge you like $250. I wouldn't waste my money on it, but that's all they do is they take the crystal ball structure, but they've built in an actual real options model. So they've got the Black-Scholes built in. So what happens is the model runs, it takes a variance, it feeds into the option pricing model, and you can see a
But
real.
even just seeing, I guess, business is still going to a price, but in essence, when you're doing the crystal ball, it is kind of.
Yeah, you can see how much the variation is. And it'll also give you the question of upside versus downside, right? Because in a sense, with a drug, you might say, what I'm worried about if I rush the drug too soon to the market is that there might be downsides I haven't thought about yet. And that's going to show up in my cash flow. So reducing the downside becomes your upside. Let's move on to a second example. You're an oil company. There are two ways to generate cash flows, right? Two places you go. One is existing oil you're producing out of the ground, you sell it, you get cash flows. That's a traditional discounted cash flow valuation. But you also have undeveloped reserves. So the developed reserves are traditional, but you have undeveloped reserves. Let's suppose the cost of developing that undeveloped reserve is X. Again, I'm going to start with an abstraction. And that the value of oil under the ground in that reserve is V. Do oil companies have a pretty good pretty good measure of, V? Most cases they do. That's actually, let's face it, geologists are much better at estimates than equity research analysts are, right? So when they tell you there's oil, usually that's because they've tapped the right rocks, they do whatever they need to do. It's 80 million barrels of oil under the ground, and you take that and that becomes. If V is greater than X, you have it in the, even if you have a non-viable reserve, you can see why there's optionality, right? You have that reserve, you have the exclusive rights for the next 15 years. Even though it's non-viable today, it could become viable. So if I were to draw a payoff diagram, the cost of developing the reserve becomes the strike price. The value of the oil under the ground is going to become the stock price. And you say, why would that change up? It's not because the amount of oil changes, but because the oil price goes up from $30 to $100. If that happens, you develop the reserve. If not, what do you pay? It's whatever you spend to get the reserve. In fact, in the context of patents, a lot of patents become non-viable. You throw them away, right? What does it cost you expended to get the patent? What are the two ways companies end up with patents? I'm sorry?
They buy it or develop.
One is they buy it, in which case the cost you paid. The other is you spend R&D to develop. That becomes, you can think of R&D as the price companies are paying to buy options. That's what pharmaceutical companies are getting. And with reserves, if you think about how you develop reserves, you go to auctions. Gulf of Mexico, the government auctions off. It's not in perpetuity, but for the next 20 years, you get the exclusive rights to reserve. That becomes the cost of the option. That's the structure of the model. Again, I want to make it specific. The value of the reserves under the ground, I take the barrels of oil you have, multiply by the oil price, net out whatever marginal cost of getting the oil out, that becomes the S in the model. The cost of developing the reserve, it's going to depend on what part of the world. And if you're in Saudi Arabia, the cost of developing reserves, you dig the ground, the oil comes out. You can even kick the ground, the oil probably shoots out. You're in Canada, you got to go 5,000 feet under the ground. You got to unfreeze the oil and get the damn thing out of the ground. A lot more work, right? So you tell me where in the world you are. The cost of developing reserve can range from very little to a lot. That becomes a strike price. The time to expiration is kind of tricky. In much of the world, oil companies get the rights to reserves in auctions. They don't get them in perpetuity. There's a certain period you get them. At the end of the period, it reverts back to the government. That becomes the life of the option. If you don't know that, it gets trickier because how much oil is there in the ground? How quickly can I get oil out before the climate change? Now you can actually say, in 2040, the climate change people are going to come for me. I've got to get as much of the 2039. It's going to be a really big year then for oil coming out of the ground. That becomes the life of the option.
What if like Saudi Aramco that like basically owns the.
If you have it in perpetuity, then I think you got to put a finite period. There's some finite thing that comes in the way. So even though you might have the rights to perpetuity, there's something that will put an end point. The variance in the value. This is an easy one. The biggest driver of how the value changes is the oil price. And here, I can actually get a variance by looking at a traded instrument. Brent crude has been traded forever. I can look at past prices, I can give you standard deviations. This is the closest we're going to get to an option that you can use an option pricing model because so that becomes the variance of the value there, the oil price going up and down. Net production revenue, right? So let's say you have a viable oil reserve today. Part of you says develop the reserve now, but the other part of you says, let's wait. Why? There might be a crisis in the Middle East. Maybe the Saudi royal family will fall. You see how this has always been with oil companies. Should you develop now or should you wait? I need to create a tipping point or you'll never develop a reserve because remember the options, you wait and wait, you wait. And here's the tipping point. If you are viable today and you choose not to develop the reserve, do you give up something? You give up the cash flows you could have got by developing the reserve. That becomes the equivalent of a dividend yield. And finally, with oil, at least with natural oil, with oil reserves and natural resource reserves. Now, if you have an in the money, or let's say you bought that Tesla option, call option yesterday, you started to exercise it. How long does it take you to do it? You get on, it's like a minute. Let's say you are Exxon. So oil price goes to 150. You decide to develop all your undeveloped reserves. Do you think oil is going to come out of the ground tomorrow? There's a development lag. You decide to develop the reserves, calls go out to the rest of the world. You know what they do, they drag the rigs out. But if you're lucky, maybe 2 years from now, oil comes out of the ground. You're saying, who cares? From an options perspective, you know why this is going to reduce the value of your option, right? One is the present value effect. The other is, why did you pick up the phone? Because oil price is at 150. Who knows what 2 years from now will bring? There's this uncertainty about it'll reduce the value of optionality, but there is a development. So here's what I'm going to do. I'm going to take again an old example because out of all the data I need, and I'll talk about when I try this on actual oil companies, the data I can find and the data I'm not able to. It's a company called Gulf Oil. And the early part of the 1980s, it was targeted in a hostile acquisition because it had some very valuable undeveloped reserves. That was the first part of the story, the reserve that people are coming after. It was estimated at 3,038 million barrels of oil in its undeveloped reserves, and that the cost of developing these reserves, if you decide to develop them all today, would be about $10 a barrel. So today we decide to develop all the reserves at one go, which would be crazy to do. You don't want to do it, but let's say you did it. It cost you 30.38 to develop these reserves. File that away. That's a cost. That's if you decide to develop it then. The average life on these reserves is about 12 years. So basically, some parts of the world, they're 3. So that reflects the weighted average of the life of all the reserves. The price of oil when I did this was $22.38 a barrel. And the marginal cost of extracting the oil out was about 7. So each barrel of oil they got out of the ground, if they developed right away, would get them $15.38. The T-bond rate then was 9%. It's a very different time. Early 1980s, you're still coming off the double digits. The T-bond rate is 9%. And Gulf, if it developed these reserves could expect to get cash flows of roughly 5% of the value. So that's what you're giving up by not developing the reserves. And the variance in oil prices is 0.03. One of the things you'll notice in when you do option pricing models is you'll use log prices to get the variance. Do you know why they use log prices? What's the Black-Scholes model built around? A normal distribution. Stock prices no price can ever have a normal distribution. Know why, right? The lowest price can go is 0. What's a log, natural log of 0? It's minus infinity. So basically it gives you a shot. It doesn't guarantee anything, but it gives you at least this remote chance that things can be normal. So when you see people using log prices, ask them, why are you using log prices? See if in fact they know the reason. It's because of this normal hope for a normal distribution. So those are the inputs. And here's what I did. I took the oil under the ground and I said, what if I, with all real options, start with that question. If I develop today, what will I get as cash flows? You get 3,038 million barrels, $15.38 a barrel. But there's a development lag of 2 years. You got to wait 2 years. So I take out the cash flows for the first, so it looks like I'm discounting, but I'm just taking out the cash flows for the first 2 years, saying I've got to wait 2 years. I come up with a value of 42.38 billion. So if I develop the reserves today, the present value of my cash flows adjusted for development is 42.38. It cost me 30.38 billion to develop the reserves today. It's nice that the difference works out to a nice round number. 42.38 minus 30.38 is $12 billion. If I did an intrinsic valuation of Gulf oil, the value I would get for those undeveloped reserves is 12 billion. But remember, I haven't developed the reserves yet. There's still 12 years left on the option. Oil prices are volatile. And I'm probably gonna say, why am I developing all this oil at $22 and something? And maybe it'll go to $40, maybe it'll go to $30. That's brought it through the variance. The interest rate was 9%. And I do, these are reserves are viable. I'm giving up something. So I built that in as the equivalent of the dividend. Let's go through again, D1, D2, N, D1, N of D2. Do you remember what I said about N of D2? I said it was, it gave you a risk neutral probability of what? That S will be greater than K, right? In this context, what is that 85.42% telling me? There's a very high chance these reserves will be developed. No surprise that they're viable reserves. N of D2 gives me a chance that those reserves will be developed. But here's the bottom line. You plug them in, you value it as an option, I come up with 13.3 billion. What is my intrinsic value? 12 billion. Viewed as an option, my undeveloped reserves are worth an extra 1.3 billion. And what's driving that premium? If I asked you to name one thing that's making that premium high or low, what is it going to be? The variance in oil prices. In fact, if the variance of oil prices drops to zero, the optionality will go away. The more volatile oil prices become, the greater the premium over the intrinsic value. The 1980s were an incredibly stable period for oil prices. They went low and they stayed low for a decade. It killed oil companies. The low oil prices affected the value of their cash flows. They have lower cash flows. And the low variance affected the optionality. You have to have at least one thing working in your favor. So where do you think you'd put oil prices now? Low level, low variance, or low level, high variance, high level, low variance, because of any of those four. So where do you think we are? High level, high variance, best of all worlds for oil companies, right? Because your existing reserves and your cash flows produce high values. Your optionality kicks in and adding a premium. It's the best of times to be ExxonMobil. It's even better to be Petrobras. Do you see why? Because the more undeveloped reserves you have, the more this is going to help you that the variance has gone up. So when you think about oil companies, ask what the oil price is, but also think about where is that variance in oil prices gone. So in the case of Gulf Oil, again, I value the undeveloped reserves, but to value the entire company, I've got to bring in the developed reserves, just like in Biogen. The developed reserves are much easier. The cash flows, I do a discounted cash flow model, traditional discounted cash flow model by discounting the expected cash flows, 915 million at a cost of capital. So no need to pull out new tricks from your bag. That present value is 5.07 billion, 13.3 billion undeveloped reserves, 5.07 billion production in place.
With the use of variance, the main assumption is that the future will be like the past.
With oil prices, that the standard deviation oil price, the level might be different, but the standard deviation is not changing. If you don't like to use historical data to get the variance in oil prices, is there an alternate route that might give me forward-looking variances in oil prices? Not oil futures, but oil. If you have oil options, you can back out an implied variance. And there are oil options. You can get call and put options. Those are traded. You can back out an implied variance. That'll give you a forward-looking stand. I think they're 2 years. They're pretty long-term options on commodities. So you can get them from those as implied variances.
Because of the technological innovations at a certain point, the historical stuff becomes.
With variance in when oil prices, though, it's driven primarily by demand and supply for oil, and that's as old as time, right? It goes up and down. So it's more of an issue with the exercise price that we put in there, because that can change as the technology changes. So if I add the reserves, I come up with the value of the firm. Think of this again as an alternate way. I could have done a traditional discounted cash flow valuation of Gulf Oil, or I can divide it up into developed and undeveloped reserves and add them. So I did this in 1984. You know what? I've never been able to do it fully for any oil company sits because the information is not there. What are oil companies required to reveal in their financial statements? They have to reveal reserves, but only viable reserves. You see why in optionality? They have to give you only their in-the-money options. I would like them all to tell you all their reserves and the portion that are, because then I can start asking the questions to bring in. That's the missing piece right now, is non-viable reserves are basically X in the company. You really don't know. But if you can get them, you can value them as well. So that's the Gulf oil valuation. You can see this play out. It gives you interesting insight. One of the things I want you to take out of real options is even if you never plan to use Black-Scholes or try an option pricing model, the implications of seeing something as an option cannot be unseen. And so now when you look at an ExxonMobil value, I want to think about not just the level of the oil price, but how the variance in that oil price plays out in the value. Let's talk about the option to expand. Again, if you go back to traditional capital budgeting, you do a project, it's negative, NPV is negative, you don't take the project. But what if that initial project gives you the right to a second project? So I'll give you an example. So let's say you decide to get into banking in India, a huge business, historically closed off to foreign investors. So I tell you, look, I will let you, open a banking business in India. And I put very strict constraints on what you can do in that initial entry. And I say, but if you do that, you get the exclusive rights to this expansion that we're thinking about in this business for the next 10 years. So you do that analysis of that initial investment, you come up with a negative net present value. Then you do the assessment of the second investment, and it's still negative. So you're saying, this is terrible. You're making me take a negative net present value project. You get the rights to another negative net present value project. But the second project, you can wait to decide, right? And what are you going to look for? How well that first project does. If it does better than expected, you will go into the second project. It's the second project that is the option. The first project is a negative net present value. So here's how it works. Yeah. Whatever additional investment you have to make to expand becomes equivalent to the strike price. You will expand only if the present value of cash flows exceed that strike price. If that happens, you will expand. If not, what have you lost? That initial project at a negative net present value, that becomes the cost of this option. This is what excites people, because when you hear the word strategic, this is it, right? Your initial investment is negative, but there are strategic reasons. If strategic really had heft to it, you're talking about the option to expand. It's part of what I call that big market pull, right? AI right now, social media in the last decade, PCs, .com, China. So let's set this up. Let's assume that you've done a discounted cash flow valuation of a software company. It's a software company that does, it basically sells antivirus protection software, protective systems. You do the present value of the cash flows, you discount back at the cost. You do everything right. You come up with a value 115 million. That's your discounted cash flow valuation. And I said, by the way, this company is accumulating data on its clients as it's providing these software services. And any time over the next 5 years, they can choose to use the data they've collected on their clients to develop a new database program that'll be a new business. And you say, okay, I'm interested, so tell me more about this. And I say, it'll cost you about $500 million to develop this new database program. Already said, that's a lot of money. Say, oh, I've looked at the cash flows, and you can make, based on what we know now, you can make about 40 million a year for the next 10 years. Already you can see this is not going well, right? I want you to invest $500 million upfront, and you're going to make 40 million every year for 10 years. You don't even need to do present value. You're already below water. But these are risky cash flows. The cost of capital for those cash flows is 12%. I've set you up, right? I've set you up by saying there are things you can do with the data, but right now they're not viable. But you can do them anytime over the next 5 years. But here's the saving grace. There's a lot we don't know. Ignorance is usually a weakness. Do you see how it becomes a strength now? So why is this good? We know nothing. things can happen. So I decided to value this as an option. Here's what it looks like. If I take the present value of 40 million for 10 years, I get 226 million. That's well below the $500 million. It's a minus $274 million NPV. Huge variation though, standard deviation of 50%. And here's the magic. I have a deep out of the money option of a big negative net present value project. I have the exclusive rights for the next 5 years. Valued as an option, I get a value of 56 million. What's driving the value? The fact that I'm so uncertain about the future. Again, it's not the option pricing model, the insight you get. I remember when I bought Facebook after the Cambridge Analytica scandal, I bought it at a price roughly equal to what I'd done as my intrinsic valuation. And I got a lot of blowback saying, what about a margin of safety, right? That's what we're taught, right? Risky companies, you need a bigger margin of safety. I'm going to push back. I'm going to argue that in a company like Facebook, I'm going to accept not just no margin of safety. And here's why. I valued Facebook as an online advertising company because that's what they made money on. And I couldn't see an easy way for them to make money from retailing or alternate, because they have 3 billion people on the platform. So if I did any of those other paths, it looked like they were all cut off. But is it possible that they could find a way to monetize? Absolutely. That's a real option. What does that mean? Even if you don't put a number, it'll mean that there are some platforms you should pay a premium over the discounted cash flow valuation because there are other things you could do with the platform. It's one reason I'm never as negative about Tesla as the most negative people are, because let's face it, there is optionality with a Tesla you will never get with another automobile company. The optionality comes from the imagination of one man thinking about things, and you might not like him, but the fact is, I mean, without Elon Musk, there would be no talk about automated driving or, he's brought that. Right now, he's saying it'll never work. It is a deep out of the money option, but if it ever does, think of how lucrative it could be. I mean, I did buy Tesla at 170. I'm still mildly underwater even after the rise yesterday, but I'm okay. Stock at 170. My intrinsic valuation was, pretty much around, it's around 175. There's enough optionality there to feed 3 different businesses, right? It could be automated driving. It could be whatever comes out of the charging technology. That optionality, to the extent that you built it, I'm trying not to double count, but I didn't do the automated driving as part of my revenue model because I don't think it's viable today. But there's definitely an optionality. Yeah.
What questions do you ask yourself to separate fancy,
I'll tell you what, until a year ago, I had not built optionality for the automated driving. I didn't think it was feasible. And then I started to see news stories from not just the Tesla fans, right? But from people actually involved in the technology of this can be done. And it's not just Tesla, right? I've seen the Waymo cars driving around. They're terrifying. One of them goes by you. There's nobody in the driver's seat. You go, what the heck is happening here? This is clearly not fantasy anymore. It is likely to happen. How big it is, we don't know. So I think there's a tipping point where you say, with Facebook, it was easier. The technology is there, but with things where there is a potential technology, it's an out of the money option. So I go into the open eye saying, look, I'm not going to pay for the $1 trillion in automated driving that somebody is done. It's going to be a fraction of that number, but a fraction of $1 trillion is still a lot of money. So the optionality comes from the fact that it's a potentially big market with a lot of uncertainty around it. And this company has an exclusivity there. That's a key word, right? I think so. I think Tesla is way ahead of everybody else in this space and actually making this. Google might do it, but Google doesn't have the stomach or the heart to be in this business. Apple tried. They've actually written off the business. Why? It's a messy business. You got to create factories and manufacturing, and none of these tech companies have the stomach for it. So if it succeeds, I think Tesla, in terms of actually putting it into practice, in a Tesla, I've actually been in a Tesla with the automated, the driver actually sits. It's terrifying. I'll be quite honest. I'm sitting back there, please God, don't let this. But it does it does a surprisingly good job, which is, given where it is. I'm not ready to turn over an entire fleet where there's nobody sitting in the car. But clearly they're way ahead of almost everybody else in making this work. So just a note of caution, as Justin pointed out, it's easy to get carried away with these big stories, especially if you're listening. So I passed it through this three passes. First is I want to know, is this first investment necessary to get my second one? Remember, I've tied the two together. Could I wait and let somebody else do the dirty work for me? So if I'm Ford, should I let Tesla do and then jump in? I'm not sure you can, but no. So that's the question is, do I need? Second, how much exclusivity is there? So let's say, Tesla comes up with a way of automated driving. How easily is it going to be for somebody else to replicate? I'm not sure what the answer is. Is it software? Is it software plus hardware? I mean, we still don't know. And that's going to be a big driver in how much optionality. And third, and is once you have that market of exclusivity, how much excess returns can you earn? All those things play out in the value of those of that option you add on. So there are lots of companies out there where people talk about strategic. I'll buy this company because of this actually makes you ask questions about what that is and how to bring in that option. So let's pass this option to expand through the real option. Is there an option here? Yeah. The underlying asset is that second, the expansion investment. The contingency is you will develop it only if the present value of the cash flows from expansion exceed the cost. Is there exclusivity? Here it's trickier. It's unlike a patent where it's exclusivity coming from governments protecting you. This has to come from what kind of advantage do you get by being the first player in this market? Okay. In some markets, it might be nothing. In some markets, it can be substantial. So you got to assess what that advantage is. And thirdly, can I use option pricing models? I'm still on very dangerous ground, right? So if you think about expansion options, unlike these natural resource options where I have the basis for trading both the underlying asset, here I'm on, no, I can't trade the option. So when I put an option pricing model to value automated driving at Tesla, it's probably not worth the effort, right? It's really a question of getting a sense of, is it a small number or a large number? But that's a test which will always keep you grounded when you do real options. Let's talk a little bit about the option to abandon. It's nice to have, not just in business, but in life, right? It's nice to be able to walk away from your mistakes. The option to abandon is really the option to walk away from a mistake. Here's the way it plays out. You take an investment. If things get bad enough, it's nice if you can abandon it, even if you have to give up half of what you invested and be able to walk away. If the present value of the cash flows drops below it. So that's why it's a put option, because it's really useful when the value. So I'll give you an example of how this might play out. So let's say you're Airbus, and I'm Lear Aircraft. Lear, as you know, historically has made these small corporate jets. And we both see that Boeing is in trouble. So as Lear, I come to you with a business idea. I say, look, we've never made commercial aircraft which are large, but I think there's a market here for 80 or 60 people aircraft. Now, would you be willing to enter in joint venture with me? So you put in a $500 million, I'll put in a $500 million. We have projected cash flows. Let's say you do the present value of the cash flows. And as Airbus, you come up with the net present value based on those cash flows. So you got to invest a $500 million to be, but the present value of the cash flows you get is only $400 million. So your NPV is minus $100 million. So you said, no, I'm not interested. But I'm Lear. I'm really, really, really eager to have you as my partner. So I come back with a counter offer. I say, look, I know you're concerned about whether this will work out. Would you be willing to become a partner if I offered you an escape hatch, which is if things don't work out, anytime over the next 5 years, you can sell your stake back to me, Lear Aircraft, and I'll pay you $400 million. What have I effectively done? I've effectively capped your losses at $100 million because you invest a $500 million. I've given you an escape loss. You do a Monte Carlo simulation, you come up with a standard deviation variance. The project itself lasts 30 years. I've given you the right to walk away for the next 5 years. You have a put option. I compute the value of the put option. So the value of the cash flows is $480 million. Right now, what you will get if you walk away is $400 million. So obviously you're not going to walk away now, but there's uncertainty in the future that's captured in the variance, and you have 5 years to make this choice. But remember, this is a finite life project. Each year that you wait, the project is going to get less valuable because it's going to go 30, 29, 28 years. So that's like a dividend yield. The project value is decreasing. Valued as an option, You can see the inputs are there. And as an option, the value that I get for the option is 73.23 million. See, what does that even mean? Remember the initial investment to Airbus had a net present value of minus 20 million? You said, no, I don't want to do it. With this option in there, the right to walk away, you actually have minus 20 million plus 73 million. It makes this investment go from being a bad investment to a good investment. But as Lear, I have to remember that I'm giving you this option, which means my NPV better be much higher than 73.23 million, because I might accomplish my objective of getting you as a partner, but at a cost that is not worth it. The option to abandon essentially means that being able to walk away is worth money, and it is valuable. In this, again, forget about the option pricing model. Think about where this shows up in discounted cash flow valuation. There are some companies that have a history of being adaptable and flexible. Some big words now, especially post-COVID. Are you adaptable? Are you flexible? When I hear the words adaptable and flexible, I'm thinking about optionality. There was a time when Goldman had a reputation that when things were good, they could find a way to make them better. In other words, they could make them into call options. When times were bad, they seemed to cut and run quicker than everybody else. In other words, that optionality. I mean, that reputation is now gone. But let's say you're valuing Goldman, you come up with a discounted cash flow valuation. The fact that they're adaptable actually makes them more valuable, because the good will get even better because they found that call option, and the bad will not be as worse because they built the escape hatches. You might never put a number on it, but you're comparing two companies, and one has a more adaptable business model, fewer fixed costs, more ways of getting out. It should be worth more than the company without that same adaptability. The option to expand, the options to abandon, and the option to delay. Let me at least set up the next option, because it's going to be, we'll finish it on Monday when we come back. When we, in corporate finance, we talk about capital structure. In fact, we just came out of the capital structure section. We talk about the right mix of debt and equity for a company. And often, in capital structure, you also have options in securities, convertible bonds, capped and float securities. But the option I want to talk about is the option that talks about financial flexibility. Let me set up the process. Let's suppose you have a company that has a 55% or a 5% debt ratio. We come up with an optimal of 40%. They should borrow more, right? So you go to the company and say, hey, you guys should be borrowing more. And the management comes back and says, but we don't want to. We know we have excess debt capacity. Why? Because we value financial flexibility. Do you see the basis for that, right? That extra debt capacity is going to give them a chance to do things in the future that they've asked. You can't dismiss it. There is clearly value. So next session, when we start, I want to talk about when is the value of that financial flexibility high for a company, which would lead them then to be under-levered, because not because they're being irrational or conservative, but because they value financial flexibility. What kinds of companies is that argument going to fly? And what kinds of companies should you push back saying, hey, you shouldn't be valuing financial flexibility. It's not worth much. So we'll talk about that on Monday. And Monday, actually, we'll finish the rest of options and perhaps start on acquisitions. But really, I want to finish options for the most part on Monday. But you have everything you need for the project. So tomorrow, in your email, you're going to get a really long email. I'm sorry, but it actually is going to list out everything about the project, including structure. And so read that damn email. Even if you've never read another email from me all year, read that one, because it is going to make your life simpler in terms of pulling things together. So I think it's a really level. That number.
My wife and I talked, by the way, about it.
It's a good way, you know what? Slow down, but it's really slow. Yeah, on the road, right? You can each car to drive that. Right? But you cannot teach human beings. So the biggest challenge is how do you deal with the freight interaction? Because if you're in a car, there's some drivers you don't get it. You have to put cars, how you say, rationally drive, and adjust it.
Yeah. Yeah, we call it by that now.